What if one of the biggest banks in the world just got the silver market completely wrong? What if the same institution that investors trusted for years suddenly watched its silver forecast fall apart overnight? Welcome back to Pulse of Silver, the channel where we break down the biggest stories shaping the silver market, global finance, and the future of precious metals. Today's story is massive because JP Morgan's silver forecast is now facing serious pressure as silver prices continue moving in ways that many Wall Street analysts did not expect. Retail investors, silver stackers, and even large institutions are now asking the same question. Is the silver market finally breaking away from traditional banking predictions? For months, major financial institutions tried to calm the market. They suggested silver would remain under control, trade within predictable ranges, and avoid any explosive breakout. JP Morgan was one of the most watched voices in that conversation. Their forecasts influenced traders, hedge funds, and even mining companies. But suddenly the market changed. Industrial demand started rising faster than expected. Physical silver supplies tightened. Central banks around the world continued buying precious metals aggressively, and investors who once ignored silver began returning to the market. Now, many analysts believe the old forecasting models are failing. Why? Because silver today is no longer driven by only jewelry demand or short-term trading activity. Silver has become a strategic metal. It is essential for solar panels, electric vehicles, artificial intelligence systems, military technology, and advanced electronics. Every year, industries consume enormous amounts of silver, yet global mining production is struggling to keep pace. This creates a dangerous imbalance between supply and demand. At the same time, inflation fears are not disappearing. Governments around the world continue carrying huge debt burdens, and many investors no longer trust fiat currencies the way they once did. During uncertain times, precious metals often become a safe haven. Gold usually moves first, but silver has historically delivered even bigger percentage gains once momentum builds. That possibility is now making investors nervous, especially institutions that underestimated the speed of this shift. Another major problem for large banks is the growing physical silver movement. Around the world, ordinary investors are purchasing coins, bars, and bullion directly instead of relying only on paper contracts. This matters because paper silver and physical silver are not always the same thing. If too many investors demand real metal at the same time, it can expose weaknesses inside the system. Some analysts believe this is exactly what JP Morgan and other banks are now trying to avoid. The market reaction over the past several days has been intense. Silver prices have shown strong volatility, trading volume has increased sharply, and social media discussions about silver manipulation are exploding again. Many retail investors believe the market has been artificially controlled for years, and recent price movements are adding fuel to those claims. Whether those accusations are fully true or not, one thing is clear. Confidence in traditional silver forecasting models is starting to crack. This story is not only about one bank making a bad prediction. It is about a much larger shift happening inside the financial world. Investors are beginning to realize that silver may no longer behave like it did in the past. The rules are changing, and the institutions that once controlled the narrative may now be struggling to keep up with the reality of a rapidly tightening market. And if this trend continues, the consequences for the silver market could be enormous. To understand why JP Morgan's silver forecast is collapsing, we need to look deeper into what is happening behind the scenes. Most people see only the daily silver price on financial news channels, but the real story is hidden inside the physical market, industrial demand, and global economic fear. One of the biggest drivers of silver right now is the green energy transition. Governments everywhere are pushing for renewable energy projects, especially solar power. Silver is a critical component in solar panels because it conducts electricity extremely well. The problem is that solar demand is growing much faster than many experts predicted just a few years ago. Every new solar project requires silver, and when multiplied across thousands of projects worldwide, the numbers become enormous. At the same time, electric vehicle production is increasing rapidly. Modern vehicles use much more silver than traditional gasoline cars because of advanced electronics, sensors, and battery systems. Artificial intelligence infrastructure is also increasing demand. Data centers, semiconductors, and high-performance computing systems all rely on silver in some form. This means silver is no longer just a precious metal. It has become a critical industrial resource for the future economy. But here is where things get dangerous for the market. Mining supply is not keeping up. Discovering new silver mines takes years. Environmental regulations are becoming stricter. Mining costs continue rising due to energy prices and inflation. Some major silver-producing countries are also facing political instability, which creates additional uncertainty. Even if companies want to increase production, they cannot simply create new silver overnight. This supply problem may be one reason why large institutions underestimated silver's potential. Traditional forecasting models often rely heavily on historical patterns. But today's market conditions are very different from the past. Demand is expanding into entirely new industries while supply growth remains limited. That creates a setup where shortages can appear faster than expected. Another major issue involves investor psychology. For years, many people ignored silver because it moved slowly compared to technology stocks or cryptocurrencies. But during periods of economic uncertainty, investors often return to hard assets. Inflation, banking concerns, geopolitical tensions, and fears about currency devaluation are all pushing investors toward precious metals again. Recently, many retail investors started questioning why silver prices remained relatively low despite strong demand fundamentals. This created growing interest in physical silver ownership. Dealers in many regions reported increased sales of silver coins and bars. Premiums on physical silver products also started rising in some markets, suggesting strong real-world demand. Now, institutions may be facing a difficult reality. If physical demand continues rising while industrial consumption accelerates, paper market pricing could become harder to control. That is why many investors believe J.P. Morgan's forecast problems are not temporary. They may reflect a much larger structural issue inside the silver market itself. And perhaps the most important point is this: silver markets are relatively small compared to gold or stock markets. That means even a modest increase in global investment demand can create dramatic price movements. If large investors suddenly rush into silver at the same time, prices could move much faster than most traditional forecasts predict. This is exactly why so many analysts are now warning that silver may be entering a completely new phase, one that Wall Street may no longer fully understand. What makes this situation even more interesting is the growing divide between retail investors and major financial institutions. Over the last few years, ordinary investors have become far more educated about the silver market. They study mining reports, follow COMEX inventories, track bullion deliveries, and analyze industrial demand trends themselves instead of depending only on bank analysts. This has created a major change in market behavior. In the past, large banks controlled most of the narrative around silver pricing. Their forecasts influenced market sentiment because retail investors had limited access to information. But today, information spreads instantly across social media, financial podcasts, independent analysts, and online communities focused entirely on precious metals. As silver prices started showing unexpected strength, many investors began revisiting older theories about price suppression and paper market manipulation. Some believe large banks used massive paper contracts to keep silver prices lower than they should naturally be. Others argue that the market is simply responding to normal trading activity. Regardless of which side is correct, there is no denying that distrust toward traditional financial institutions is growing. This distrust became even stronger after several banking crises over recent years. When people see banks facing liquidity problems while governments continue printing money and increasing debt, they naturally start looking for safer assets. Precious metals benefit directly from that fear. Gold usually gets the headlines first, but silver often attracts attention because it appears more affordable to average investors. Another reason silver is gaining momentum is its historical relationship with gold. Many analysts watch the gold-to-silver ratio closely. This ratio compares how many ounces of silver equal 1 ounce of gold. Historically, when the ratio becomes very high, silver is considered undervalued compared to gold. Recently, some investors argued that silver remained historically cheap despite strong industrial demand and rising economic uncertainty. If silver starts catching up to gold, the upside potential could become significant. This possibility is exactly why many investors are paying attention to J.P. Morgan's forecast collapse. Markets do not usually react this strongly unless confidence is beginning to shift. Meanwhile, central banks continue buying gold aggressively around the world. While they focus mainly on gold reserves, this trend indirectly supports silver by strengthening the entire precious metals sector. When confidence in fiat currencies weakens, investors often diversify into multiple hard assets, including silver. There is also another hidden factor many people overlook: inventory levels. Some reports suggest available silver inventories on major exchanges are becoming tighter. If industrial users begin competing directly with investors for physical silver, supply stress could increase rapidly. In commodity markets, shortages can trigger explosive price reactions because buyers become willing to pay increasingly higher prices just to secure supply. This creates a dangerous situation for anyone betting against silver or expecting prices to remain weak. Forecasts based only on old market conditions may no longer work in today's environment. And if institutions position themselves incorrectly, they could face major financial pressure as the market moves against them. The silver market has always been known for sudden and violent price swings. But this time feels different to many investors because the fundamentals behind the move appear much stronger and more global than previous rallies. The combination of industrial demand, investment demand, economic uncertainty, and supply constraints is creating a setup that could reshape the market for years ahead. And if that happens, The collapse of JP Morgan's forecast may eventually be remembered as one of the first warning signs that the silver market was changing forever. Now let's talk about what could happen next, because this is where the story becomes even more serious. If silver continues moving higher while physical demand keeps tightening, the pressure on large financial institutions could increase dramatically. Markets often stay quiet for long periods before suddenly moving very fast, and silver has a long history of explosive rallies once momentum begins. Many experienced investors remember what happened during previous silver surges. In certain periods, silver prices doubled or even tripled within relatively short time frames. These moves usually happen when fear entered the financial system and investors rushed toward hard assets. Today, the world is once again facing major uncertainty. Inflation remains stubborn in many economies. Government debt levels are extremely high. Geopolitical tensions continue rising. And confidence in traditional financial systems is weaker than it was a decade ago. All of these factors create a favorable environment for precious metals. But silver has an additional advantage because of its industrial role. Unlike gold, silver is heavily consumed in manufacturing. Much of the silver used in electronics and industrial applications is difficult or expensive to recycle. That means large amounts of silver effectively disappear from available supply every year. This creates a long-term supply challenge that many investors believe Wall Street underestimated. If demand continues increasing while mining production struggles, the imbalance could eventually force prices much higher. Some analysts even argue that the silver market is already operating near a structural deficit where annual demand exceeds new supply. At the same time, investor behavior is changing rapidly. Younger investors who once focused mainly on cryptocurrencies are beginning to explore hard assets again. Economic instability has made many people rethink what true wealth protection looks like. Silver, because of its lower price compared to gold, often becomes an attractive entry point for new investors. Social media is also accelerating market awareness. Every major price move now spreads instantly online. Videos discussing silver shortages, COMEX inventories, and central bank policies receive millions of views. This constant flow of information creates momentum that did not exist in older market cycles. For banks like JP Morgan, this creates a difficult environment. Large institutions depend on stable and predictable markets. Sudden retail investor participation combined with industrial shortages can create volatility that becomes very hard to manage. Forecast models built around old assumptions may no longer capture the reality of modern demand trends. And here is the key issue many analysts are now debating. What happens if physical silver availability becomes extremely tight? In commodity markets, scarcity changes everything. Buyers stop focusing only on price and start focusing on access. Companies needing silver for manufacturing cannot simply pause production because prices rise. They still need supply. This can create bidding wars that push prices far beyond what most forecasts originally expected. That is why some investors believe the recent collapse in silver forecasts is only the beginning. If the market enters a true supply crisis, silver could experience moves that shock both Wall Street and ordinary investors alike. Of course, markets never move in straight lines. Volatility will remain high, and silver has always been known for sharp pullbacks and emotional trading. But the bigger picture is becoming harder to ignore. The forces driving silver today appear stronger, broader, and more global than many previous market cycles. And that may explain why so many traditional forecasts are suddenly falling apart. As we close today's discussion, one thing is becoming very clear. The silver market is entering a period of major change. JP Morgan's silver forecast collapse is not just a story about one bad prediction. It reflects a deeper shift happening across the global financial system. Investors are questioning old assumptions, industrial demand is rising faster than expected, and physical supply pressures continue building beneath the surface. For years, silver remained one of the most overlooked assets in the financial world. Many investors ignored it while focusing on stocks, technology companies, and digital assets. But now silver is returning to the spotlight for multiple reasons at once. It is both a precious metal and a critical industrial material. It benefits from economic fear while also gaining support from technological growth. Very few assets have both of these advantages together. The coming years could become extremely important for silver prices. If inflation continues, if governments keep increasing debt, and if industrial demand keeps accelerating, silver may attract far more attention from institutional and retail investors worldwide. And if physical shortages begin appearing more clearly, the market could become far more volatile than many people expect. At the same time, investors should remember that silver is never a perfectly smooth investment. Prices can move sharply in both directions. Emotional trading, market manipulation fears, economic data, and central bank decisions can all create sudden swings. That is why understanding the bigger picture matters more than reacting emotionally to daily price changes. What we are seeing right now may only be the early stages of a much larger transformation in the silver market. Whether JP Morgan eventually adjusts its forecasts or not, the important story is the changing reality underneath the market itself. Supply pressures, industrial growth, and investor distrust in traditional systems are combining in ways that could reshape silver's future completely. And if this trend continues, many people may look back at this moment as the time when silver finally broke free from the expectations of major Wall Street institutions. Thank you for watching Pulse of Silver. If you enjoyed this breakdown, make sure to subscribe, like the video, and turn on notifications so you never miss the latest updates on silver, gold, and the global financial markets. Let us know in the comments whether you believe silver is preparing for a major breakout, or if Wall Street will regain control of the market narrative. This video is for educational and entertainment purposes only. It is not financial advice. We are simply sharing market opinions, news, and analysis based on publicly available information. Always do your own research before making any investment decisions. Precious metals markets can be highly volatile, and prices may rise or fall unexpectedly. Please speak with a qualified financial advisor before investing your money.